Gulf Coast Financial Advisors has a question for you. Is your retirement inflation-proofed? Here's what we mean. In retirement, chances are that you are on a fixed income with variable expenses. So how do you not run out of money when the cost of just about everything continues to go up? You inflation-proof it. Josh Knoll and the team at Gulf Coast Financial Advisors can show you strategies to help combat inflation so it doesn't outpace your retirement income. Inflation could take a huge chunk out of your retirement savings, but it doesn't have to. With some simple planning, inflation can go from being a major disruption to a minor annoyance. Call Josh Knoll and the team at Gulf Coast Financial Advisors now to start inflation-proofing your retirement today. 251-333-5151. That's 251-333-5151.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone, and welcome to Coasting in Retirement. I'm your host, Josh Knoll, and I'm joined by my co-host, Michelle Lee Melton. Michelle, how you doing?
I'm hanging in there today, Josh. How are you?
Well, I'm doing pretty great. I'm very pumped up about this show. We have got some great information. We're going to be talking about a topic that is a little bit evergreen. Some shows we do are topical of the week. Some shows are going to be a little more evergreen. This one is an evergreen show for sure. It's going to be about annuities. Before we dive into that, though, just for you all that are new to the show, I am the owner of Gulf Coast Financial Advisors, an independent financial planning firm based out of downtown Fairhope, Alabama. Michelle and I are here today to discuss the financial topics really relevant to those in or near retirement, living here along our part of the Gulf Coast. So, Michelle, as we kick this off, as someone, you that are not in the financial services industry, I am, hopefully, what pops in your mind first when you hear the word annuities?
Something that's annual and also very boring.
Very boring. Okay. Something that sounds old, like some your grandma would have?
It sounds like something older people would have.
Very good. All right. Now, we did not pre-plan that. She didn't warn me about that. So, not to pick on you, but that's a fairly common response when someone mentions annuities. Is that something my grandma used to have? So, probably, pretty good reason the financial industry has really not done a very good job of educating people when it comes to annuities, particularly people that are, younger than 50, 40 years old, our age, if you will. And they really haven't done a good job with how annuities are explained and definitely with how they are sold. So that's why we're going to be talking about today. In fact, really publicly discussing annuities, not only does it sound, as Michelle said, sometimes outdated, but it also sounds a little misunderstood.
Annuity schmooties.
Right. And discussing them, and honestly and publicly, can raise so many red flags that I feel compelled to even offer a little brief disclosure before we get started. Listeners, this show is not intended to convince you to buy an annuity. In fact, we're going to be hitting the subject right on the head, and we're going to be as open, as honest as possible. I would say even skeptical, because there's so much disinformation out there about annuities, both good and bad. It really is kind of a cats versus dogs, Republican versus Democrat type of argument. When it comes to annuity, you're rarely going to see a nuanced discussion. It's usually black or white. And honestly, I can see why. Even in doing my own show research, I ran across a banner ad on one of my investment websites that honestly what makes me and probably any other fee-based advisor want to throw up in their mouth a little bit. It was from annuityalliance.com, and it said, quote, "Today's highest annuity returns. Earn 8.5% annual return and grow your savings risk-free." All right. So later in the show, we're going to circle back to that ad and why it is both mathematically accurate and kind of misleading all at the same time, which is a really good synopsis of annuities, okay? All right, so first, what we need to do as we're laying out the main topic of the show is we need to explain to our audience and to other investors, a lot of people don't realize that there are several different types of annuities. They kind of throw them all in one big bag. So when we're labeling all these annuities, when these advertisements and these articles label annuities, especially some of the articles that we're going to talk about, when you paint them with one big broad brush, whether it's bad or good, it's really inaccurate. All annuities do have some common attributes. They're supplied by insurance companies, there's surrender periods, and all involve at least some element of loss of control of your principal, or premium as it's called in the insurance world. Even with all those commonalities, there's still a lot of differences when it comes to annuities, especially for any of those that are looking at the purchase of annuity. You need to be armed with the relevant information for that purchase. So first, let's do this. We're going to list the different type of annuities, then we're going to break down each individually. First up is deferred income annuities. Then we've got immediate income annuities, or what's commonly referred to as single premium immediate annuities. That's SPIA. If you really want to get into Nerdville here, SPIAs. We have fixed annuities. We have multi-year guaranteed annuities. Those are referred to as MYGAs. And then we also have fixed index annuities, not to be confused with fixed annuities. We'll explain the difference later. And then lastly, we have variable annuities. So that's the ones we're going to be talking about today. If there's a different type of annuity out there that you listeners are familiar with, I've been doing this going over 13 years. If there is one like that I haven't heard of, that means it's really not relevant to the industry, at least not in my part of the industry. So let's start with deferred income annuities. I want you to think of these as the most pension-like of the annuity options. In fact, a lot of people don't realize that a lot of pensions, the payout is facilitated through an insurance company. So sometimes you can ask an investor, hey, would you like to have a pension? Most people say yes. You ask that same investor, would you like to have an annuity? And they say, no, I heard annuities are bad. Well, sometimes they're kind of very similar, one side of either coin. We'll get into that more later. The main point of a deferred income annuity is you make contributions or multiple contributions to the annuity over a certain period of time. Then you have an income start date that's deferred down the road, usually after, typically in retirement. And however much you receive when you defer it will be determined upon what's the date, how long did you contribute to it, how much did you contribute to it. There's a little bit of element of control on the actual final payout, but what you don't have control over is the premium or the principal when you pay it into the insurance company. Typically with a deferred income annuity, once you make that premium payment, that is the insurance company's capital to work with without severe penalties on a deferred income annuity. So the main thing with deferred income annuities, we're going to discuss more as we go through our episode here today, is they are very good for having pension-like annuity guaranteed lifetime payouts. On the flip side of that, you've got to be careful with them when it comes to inflation, because typically they do not keep up with inflation as much as some other annuities. All right, they're kissing cousin immediate income annuities or single premium immediate annuities, SPIAs. There's a lot of vowels here, Michelle.
I like MYGA. That sounds more powerful for some reason to me.
Well, SPIA and MYGAs get lumped in together, but they're very, very different, which we're going to explain.
We'll find out.
That's right. So SPIAs are similar to a deferred income annuity, except that it typically involves paying a single premium. And typically, if you're going to do it, you're putting in a pretty decent amount of money. And then the income, as opposed to a deferred annuity, that income is going to start pretty much instantly, typically 30, 60 days out. With this type of annuity, you definitely lose control of your premium. Once you write to the insurance company, you get past the free look and all these other things, it's gone. It is now going to be turned into an income stream. And just like with deferred income annuities, you have to be careful with inflation. All right, so fixed annuities, Michelle, MYGAs, multi-year guarantee annuities. The easiest way to think of these they are the insurance company's equivalent to CDs. You typically see 3 to 7 year terms on these, 3 years, 4 years, 5 years, so on and so forth, with a fixed interest rate for the set number of years. For example, recently did a 3-year MYGA. We got 4.5% on it, which was higher than what this particular client's bank was offering her. That is kind of the main thing to remember is, even though they are kind of CD alternatives, typically they have a little bit longer period. And more importantly, they are not backed by the FDIC like a bank CD would be. They're backed by the ability of the insurance company to make good on their promises, which historically they've done pretty good with MYGAs, but just remember that when you're looking at these. All right, next up, fixed index annuities. These are definitely the most popular annuity among insurance companies and producers right now. And here's how it basically works. You put the premium into the annuity. It tracks an index. So for example, the S&P 500. It does not invest in the index. That would turn it into a variable annuity, but it tracks that index. NASDAQ, S&P 500. Sometimes they get kind of esoteric with some of the indexes they track, but you have some control over which index you're tracking. What happens is you track that index, you get a cap. If the index goes up 10%, if your fixed index annuity has an 8% cap, you get to participate in 8% of that 10% growth. You say, well, that sucks. Why don't I get the full 10% or 12% or whatever the index is that year? Here's the trade-off. In exchange for that, typically, most insurance companies are going to give you a 0% floor. What that means is if that index that you're tracking goes below 0% for the year, like -5%, -10%, the insurance company is going to cap your loss or lack of loss at 0%. If you've ever heard zero is your hero, then you've heard somebody describing a fixed index annuity. Most of these fixed index annuities have longer surrender periods. They definitely have higher fees compared to some other annuities. And, Michelle and I have talked about this a little bit before the show, to be open and honest with everybody that's listening to this. And some of you producers that tune into us will cringe, but they definitely have relatively high commissions compared to a lot of the other industry. And you also have to really look carefully at some of the things that they get promoted with. You remember the 8.5% return banner ad we mentioned earlier? Well, that is going to be, I didn't even click the ad because I already know it's referencing a fixed index annuity. That is a basic selling feature where you get to participate in some of the market upside, but there is nuance around that 8.5, which I'm not trying to do constant teases here, but we definitely get into it more later in this episode. All right, last up, variable annuities. So a little bit of a cop-out here. I'm an SEC registered fee-based investment advisor rep. I'm not a broker-dealer, FINRA registered rep. So I don't offer VAs. I don't sell them. I don't service them. I don't do anything with them. I'm familiar with them. I worked with them in the past when I did have FINRA registration, but I don't anymore. They are similar to a fixed index annuity, except that there is a sub-account that is actually invested in the market, not just tracking it like you did with the fixed index annuities. And at least with most of the VAs that I've seen, that sub-account is going to be invested in a collection of mutual funds, sometimes ETFs, but there's the biggest difference between them and a fixed index annuity in broad terms is you absolutely can lose money. You can lose value in the sub-account in a variable annuity, where on the fixed index, they try to keep you at a 0% floor, again, generally speaking. There are things that come along with the variable annuities. There's death benefits, there's premium protection riders, there's income riders that can be appealing to some folks. And then, of course, they aren't limited because you can lose money in a variable annuity. Generally speaking, they're not limited on the upside. If your sub-account does well and does 12% gain or 15% gain, you get the full amount of that versus a cap rate. So here's the bottom line with all that. And we're going to talk more about this as the episode goes on. If you are looking to incorporate annuities into your financial plan, then it needs to be done with appropriate education and with your eyes wide open as what you're getting into. We do, Gulf Coast Financial Advisors, we do use annuities in our practice, but it's done with a very specific purpose every time. We're more than happy to help you dissect and understand an annuity that you're considering buying, whether it's with us or if you're actually being presented by one. If you want to do that, if you want to have a free evaluation of anything that's been on the table, especially if it's a complicated annuity product like a fixed index annuity, why don't you give us a call at 251-333-5151. You can set up an appointment. It's no obligation, no cost. Or if you prefer to reach us through the website, visit us at gulfcoastfa.com. That's GULFFA as in financialadvisor.com. All right, quickly before we move on to segment 2, for those of you all new to the show, one of the things that we always point out is our financial planning process. This annuity discussion is going to go into that because a lot of the things that we deal with annuities are either a person has an existing annuity or is looking at an annuity, or when they come to us and the annuity becomes part of the conversation. Any of those three scenarios are going to be part of a comprehensive financial planning process. In our process, first we figure out how much money you'll need to retire for the retirement you've been dreaming about, not the retirement that you settle for. Next, we're going to uncover the main risks that are posing a threat to your retirement. Those are inflation, stock market volatility, Michelle's favorite word, potential tax increases, skyrocketing healthcare costs, et cetera, et cetera. Then we discuss options for generating income in retirement and putting your investment portfolio to work doing specific jobs. This is one area where annuity may become part of the conversation for generating income, lifelong income. We'll get more into that in a little bit. And then finally, we're going to discuss how to keep your current standard of living in retirement, even if costs keep rising. So again, if you'd like to have that conversation, give us a call, 251-333-5151, or find us at gulfcoastfa.com. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance. It seems like there's major headlines every week affecting investors, especially those in or near retirement. So I'd like you all to join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned. Hi, everyone. This is Josh Knoll of Gulf Coast Financial Advisors. Are you looking at retirement in the upcoming year? Are you asking yourself if now is the right time to retire due to inflation and the stock market declines? Don't second guess your retirement strategy. Sit down with a professional or get a second opinion that you may need. Why don't you give Gulf Coast Financial Advisors a call today? You can find us at 251-333-5151, or you can visit our website at gulfcoastfa.com. That's GULFCOAST. FA is in financialadvisor.com.
Hi, I'm Michelle from Coasting in Retirement, a show that you might have heard on Sundays at noon. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. As we discussed before the break, it seems like there's major headlines every week affecting investors, especially those in or near retirement. So Coasting in Retirement's co-host Michelle and I are going to help you all understand and decipher the deeper meaning of these headlines, particularly the ones that relate to our show topic today, which is annuities, and those that have an impact on those in or near retirement. So without further ado, here's Michelle with the news of the week.
Okay, annuities. I don't know about that.
Your
All
favorite
right.
thing.
That is one of my
You were
favorites.
so excited when I told you this show was going to be about annuities.
Okay.
But it's really important, right?
Allegedly.
Well, you're learning a lot
Yes,
too.
okay.
Everybody is.
Okay.
Okay.
All right, first off, we're going to go to a site called the Annuity Expert, and the title of the article is Why Annuities Are a Poor Investment Choice.
Okay. So part of the articles that you and I picked this week, we wanted to kind of show both sides of the coin. The one thing that we kind of had a hard time finding was anything that was nuanced and kind of in the middle. So as we go through these headlines of the weeks when we're doing our show prep, yeah, you got stuff like here where why annuities are a poor investment choice. I mean, just bam, there it is. So first, this article actually is kind of a prospecting type of article designed to get its author some more client opportunities. That's not a judgment, just an observation. He was a licensed insurance agent when I looked him up. The main takeaways are things we discussed early in the show with annuities that you got to remember. Typically, they involve a long-term contract. There is some type of loss control over your investment. Yep. Sometimes there's no or low interest earned, and that may be part of the whole process. And some types of annuities have high fees. I think another main takeaway from this article, Michelle, is, in my humble opinion, I think when we're discussing annuities, it's important that you are talking to a securities licensed financial professional and not just a licensed insurance agent. I'm sorry, my licensed insurance agent brethren out there. And the reason I say that is, I know it sounds a little arrogant, given that, and self-serving, given that I'm a securities licensed advisor, fee for service specifically. But I say this because with the annuities, particularly the FIAs, the fixed index annuities right now, which are the hot topic of the day, they're complicated. And there's really a lot of honestly, Michelle, there's kind of a lot of talented BS artists out there selling them without giving any true accurate portrayal of what they do. So this article asks and answers a lot of questions. One of the questions it asks itself are annuities a scam? No, generally speaking, they're not. The scam part typically comes into unrealistic promises and misstatement of fact. If it's not in writing, here's the thing, bottom line, folks. If it's not in writing and it's not understandable, then it doesn't exist. Remember that when it comes to this. That's why he says annuities are a poor investment choice. All right, very good. What do you got next?
Okay. Well, we're going to do two headlines because you were talking about how a lot of them contradict each other and it's hard to find middle ground. So we're going to do these both at once because it kind of argues both of the sides of a particular product. So Kiplinger says that fee-based annuities may not be your best bet, while NASDAQ.com seems to have a totally different opinion in their article titled Fee-Only Annuities. Will they be a game changer for clients, advisors, and an industry? So come clean. Which one is it?
Which is it? All right. So first, there's a reason we didn't talk much about fee-based annuities, or really how annuities pay out their commission anyway in the opening. So let's do that now. In broad terms, most annuities are sold on a commission basis, typically a percentage of the annual premium. Different types of annuities pay different rates, and typically the longer the surrender period, the higher the payout to the agent. For example, a 3-year MIGA, generally speaking, will have a much lower commission than a 12-year surrender period fixed index annuity in general. Now, let's contrast this commission base with fee-based annuities. The fee-based annuities mostly sprung up in response to the Department of Labor's best interest rules back in 2017, I believe, and folks wanted to fall under the fiduciary umbrella of fee-for-service while still using annuities. So I've been doing this financial services thing now for over 13 years, and to be honest with you, even with the DOL and the minor pop it gave the fee-based there for a while, and the minor ding it gave commission-based annuities there for a while, I still don't see where fee-based annuities have made much of a dent in the overall industry's production. And maybe I'm missing it. Maybe that's not something that's done a lot there on the Gulf Coast, but I just don't see how they are a significant, relevant part of the conversation. And I think part of this, I think there's reasons why. The product themselves, annuities in general, don't typically require much ongoing guidance. I mean, it's kind of one of the appeals when you're a producer of selling them is sometimes it's a set it and forget it argument. I guess the producers could make an argument for fee-based on a variable annuity because there is some management going on in the sub-account and the investment accounts. Go back to our previous segment if you want to understand what I'm saying there. But things like a fixed index annuity, they're just going to track an index anyway. So there's really not a lot of adjustments being made. If there's not a lot of work being made, then it's kind of hard to justify an ongoing fee. So in summary, yes, fee-based annuities are a nice thing for fee-based advisors to point to. But a lot of times it just means you're paying the same amount of commission for the same amount of work. You're just paying it over a longer period of time. That's a great find, Michelle. Great find on that. What do you got next?
Okay, so next up is another contradictory double whammy, which
we found all the kinds.
I know, right?
Right.
So it's kind of like cats versus dogs mentality to the information available of annuities. So we'll start with the pro annuity article from CNBC Business. Despite what you've heard, annuities aren't all that bad. I like that this read much maligned. You don't see that very often, or read that very often, but that's in this article.
Much maligned. Well, here's what's funny is we're calling that a pro article.
I know. And it says much maligned.
And it's like full of double negatives.
Financial product.
So that kind of tells you. And here's the thing. Here's what's funny. I didn't even mention
a slippery slope, these annuities.
Well, it is. And a lot of it is because how they're sold. The old saying that annuities are sold, not bought. There is some truth to that. And part of it is because it can be a little bit of a free-for-all. They're not as regulated, and typically the guys that sell them, the men and women that sell them, are not as regulated as the securities license people are. So there's that part. The other thing that is really important to what you're saying here is the double negative on the thing. To find even a semi-positive thing on it, we had to dive into this. And what it fails to mention, or what I failed to mention earlier in the show, Michelle, is annuity sales are up 27% this time year over year. So they actually are increasing. So
they don't listen to your show, clearly.
Well, here's the thing. Remember what I said earlier. I'm not here to sell annuities. I'm here to actually try to explain so you folks understand they have a purpose if they're used properly. Here's my example. If you're trying to use an Allen wrench when you need a Phillips screwdriver, then you're just going to get frustrated. And if you're trying to use a fixed index annuity when you really want a deferred income annuity, you're just going to feel frustrated and you're going to feel like you got the wool pulled over your eyes. So what do you got to do? First thing is you got to do your own research. Don't just totally buy the salesman or saleswoman promises because you're going to get frustrated. They intend to make sure you buy that product. If you're working with a fiduciary financial advisor, it's usually a bit different process because they're trying to make something fit into a financial plan. There's a little more accountability. But at the end of the day, what you got to do is remember, what do annuities do well and what don't they do well? Well, here's what they do well. They provide income streams. They protect against longevity risks. They provide capital preservation in some cases. Sometimes they provide tax deferral. What do annuities do poorly? Capital appreciation, at or above market growth, liquidity. I mean, even the variable annuity guys have to admit that while they don't cap growth like a fixed index annuity does, they still have pretty hefty fees eating away at the capital growth.
And
so
don't lessen your taxable income either, right?
Well, on certain situations, that's right. Yeah, sometimes you can take a capital gain and magically turn it into ordinary income, and that's another part of the conversation to have. All right, very good. So that was a positive side. Lord, what is the
you had to dig deep for the positive,
what's
but
the negative
with
side?
much malign. Okay, so back to Kiplinger, which obviously likes to throw shade on annuities.
It feels that way, doesn't it?
Yeah. Kiplinger states very clearly, quote, the strong case against buying annuities, unquote.
All right, so let me ask you, Michelle, in your daily life, the rare, or not rare, but the occasions that someone has mentioned annuities. Well, not only did it put you to sleep, but if someone had an opinion about it, did it tend to be kind of a strong opinion, like, stay away from those things?
Actually, the only person besides you that I've talked to about are happy with their annuities, but they're well over 60 years old.
Right, so they have income annuities,
Yeah.
functioning like a pension. Very good.
Yes.
Thank you for that. Okay, so this article appears to be written by a fee-based advisor, which is the same as me, and so I think he makes a lot of good points, and I tend to agree with him. For example, the author is referring to variable annuities in this article when he says the strong case against buying annuities. And what he's saying is variable annuities do typically have a quote-unquote high commission structure. They are generally expensive with the expenses you pay in the sub-accounts and things like that. And they often have income riders. Sometimes they're called guaranteed withdrawal benefits in some cases that don't always pass the mathematical squeeze test when you really dive into them. But here's my pushback on the writer of this article. I didn't write his name down. So, but for the love of Pete, your article is titled "The Strong Case Against Buying Annuities," when it should say "The Strong Case Against Buying Variable Annuities," so that people can at least try to recognize the differences. You can apply some of this logic to the other type of annuities, but you're trying to say that's like you trying to say that when someone is looking for a deferred or an immediate income annuity that want guaranteed income, like the ladies or the people that you reference, you're saying it's bad for them when it probably they're very happy with the check that they get in their mailbox or their account every month, right?
Yep, so far so good.
Yeah, think about that when you all are writing this. Be a little more specific. The days of just throwing shotgun in this thing.
Yeah, there's all kinds of flavors.
There's all kinds of flavors. All right, just don't be product specific with your criticism, dude. All right. All right, what's next?
Okay, so the last one for this week, Canvas Annuity has an article that discussed the similarities and differences between annuities and pensions. Okay, well, I have a pension.
Do you have a pension, right?
Yeah, so
Yes.
Do I have an annuity? Do I want an annuity? Tell me more.
Okay, so first, let's talk about what the difference is, the broad difference between pensions and annuities. Pensions are typically employer-funded. They're called defined benefit retirement plans. What does that mean? Defined benefit means that at the end of the time period, the amount of benefits you're going to receive in the form of a distribution should be defined. You should know about what it is ahead of time. Think of that as a contrast to defined contribution in a 401k, where you know how much you're putting in. You're not entirely sure how much will come out because that will determine on time and market performance. All right, so in a pension, your eventual payout is going to be determined by your years of service, your age, and your income. You'll often see, here's where this starts answering your question, Michelle. You'll often see where they use annuities at the tail end of a pension plan to provide the actual lifetime income. I worked on one the other day where Transamerica was actually the one taking the payment amount and offering the lifetime income out of that pension. So the most closely held annuity that would be similar to a pension would be a deferred income annuity, which we talked about earlier. Contributions are made periodically throughout the years leading up to a future income payment. The difference would be in a privately held deferred income annuity, you're the one making the contributions, not the employer. Then a couple of last broad statements on the article, Michelle. Private pensions, as you very well know, because you're fortunate to have one, private pensions are becoming less common. Most pensions you see now are usually government employee related type of things, or at a very large kind of a historical type of industry. For example, I know Ascend Performance Materials in Pensacola offers a pension, but more or less for the majority of you all that are not in a government type employment or in a large type of factory setting, if you want to create your own type of pension, you may want to take a look at a deferred income annuity. All right, very good. Michelle, great job with the headlines.
Hooray.
Yes, those are all important pieces of information for those in or near retirement. Now, for those listeners that are impacted or curious learning more about the things we talked about during the news of the week, you can give us a call to set an appointment at 251-333-5151, or you can find us at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, coast, like the name of the show, FA is in financialadvisor.com. All right, folks, coming up after the break, we get to have a little fun, and probably I get to get picked on a little bit by my co-host, Michelle. Our next segment is titled Where Josh Nailed It, Where Josh Was a Little Off. I'm going to share some opinions I've made public that proved fairly accurate and for balance, or at least to be fair. a few where I didn't quite stick the landing. I am human after all. See you after the break. Hi, everyone. This is Josh Null of Gulf Coast Financial Advisors. Join me this Sunday at noon for a show called Coasting in Retirement. It's an hour full of just the right tips and ideas to help you get the retirement that you've been dreaming of. That's every Sunday at noon Central Time, right here on the Talk 106.5 FM.
Hi, Michelle here. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast Financial Advisors a call today and schedule your no-obligation in-person review with Josh and his team. Maybe it's time for that second opinion. Make sure to call 251-333-5151 or visit us on the web at gulfcoastfa.com. That's GULFCOASTFA as in financialadvisors.com.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
All right, welcome back. So the point of Coasting in Retirement is to offer guidance to those in or near retirement, which means I often give my professional opinion. And while I'm very proud of the thought, care, and due diligence I put into giving my professional opinion, both on this show and in my financial planning practice, I'm also human, which means I don't always stick the landing perfectly. So each week, Michelle and I get to poke a little fun at some of the things that I've said or thoughts or opinions I've had. They're not necessarily all related to financial. But we also, to be fair, some of the times I'm pretty accurate. So we call this segment Where Josh Nailed It, where Josh was a little off. All right, Michelle, what is first?
Okay, so Josh, let's start with something you mentioned at the beginning of the show, that annuity ad that was screaming 8.5% return and risk-free growth. So I believe what you're saying is that there's a difference between return of your money and return on your money. So did you know it with this opinion, or are you a little off?
All right, so first, this is a great way to kick off the segment. I do feel like I nailed it. I do also, that ad that we're talking about at the beginning of the show, it said 8.5% guarantee with risk-free growth. And as I said earlier, that may be mathematically accurate, but it in my opinion, it's horribly misleading. Here's what I mean by that. First, let's parse out that wording of that Annuity Alliance banner ad, because each word matters, and I'm sure it had to pass some form of compliance. When you're saying 8.5%, you're not, what people hear is, they hear guaranteed 8.5% return on my money, as if you put it into this CD on steroids, and instead of getting 2%, you're getting 8.5%. That's not what they're referring to. They're referring to 8.5% return of your money in some type of income rider. Okay, that they're either talking about that, or potentially, and I doubt it, or they're potentially talking about the cap. Remember in the show earlier, we talked about fixed index annuities, how they track an index. Index does 12%. They're capped at 8%. You get the 8%. Great. Pat you on the head. Off you go. Hey, what about the 4% I left on the table? Well, next year when the market's down 5%, you don't lose any money. That's a trade-off. So my guess is on that particular ad, because I didn't click through it, because those, I'll be honest with you, those ads just make me throw up a little bit in my mouth.
They probably go down some rabbit hole, though.
They do.
Yeah.
I'm almost positive they're talking about return of your money, because that's how they do it. They get it with the 8.5. I've seen a lot of them, 7% guarantee return. And it's not that they're not giving you 7% of something. Just remember, it's return of your money, not return on your money. And then the last thing is the risk-free. It's not 100% accurate. I mean, yes, there's a 0% floor on there, but for them to say risk-free growth, there is no such thing as risk-free growth.
Right.
There is no such thing. The only
risk-free anything.
I mean,
maybe
we even have to give some disclaimers when we're talking T-bills and T-notes and things like that. So just be careful with those kind of things. All right, great. So nailed it. What's next?
Okay, Josh, you've expressed this opinion as lately as in this show. That most of the time when someone writes an article about annuities, whether pro or against, they lump all the annuities into one basket, and this can be very misleading. I already know the answer this one because you nailed it because we learned it was, 4 or 5 different annuities?
Yes. Yeah. So nailed it. And here's what I'll say. Financial articles have gotten definitely more accurate. I've been doing this over 13 years. They definitely have gotten more accurate over the years on some regards. And then other regards, like you said earlier, some of them are just thrown out there for clickbait because they're trying to either make an annuity sell themselves or get you to look at a different type of investing. But one way or the other, here's the thing. I know annuities have more similarities than differences, but it's silly at best and it's ignorant at worst to lump them all together. There's a recent MarketWatch opinion article, Michelle, called "Why Annuities Are a Bad Idea for Almost Everyone." It's very similar to the how do you say that?
Kiplinger, it's hard.
Well, it's my overbite. I can't do it. The Kiplinger article that you mentioned earlier during the News of the Week segment. That article was talking about variable annuities, while this MarketWatch article, again titled "Why Annuities Are a Bad Idea for Almost Everyone," was specifically talking about deferred income annuities. But you wouldn't know that by the title or the article information. It's not that the author is wrong, and I can appreciate how emotional some of these authors get talking about this sensitive topic because I've wanted to pull my hair out sometimes when people come in and tell me some of the things they've been told about the annuity they're looking at being sold to. It's just that the author is using a shotgun approach and hitting all kinds of different products with that broad statement. So I nailed it. Yes.
Okay. What about this one? Utilizing insurance products that feature capital preservation with some upside potential. Nailed it or a little off?
Okay, again, so this one, both, right? This is one where we actually have some nuance as opposed to the people writing about annuities. So it's a nuanced question with a nuanced response, a political response, yes and no. So let's talk about the role insurance plays in our practice. I started off a few years ago I was a little off on that subject a few years ago when it came to retirees in my client base. But let me explain. As an independent financial advisor that works with a larger independent RIA, and for both me and my clients' investment management needs, I take a certain route when I'm looking at somebody's financial plan. And back then, it really was a matter of what is the best fit for looking at fee-based or fee-only or things of that nature. And part of that was just like everybody else, even though I've been doing this for a number of years and I've been on Earth for almost half a century. Holy cow, I got a birthday coming up.
Yeah.
It's getting close. It's getting close. The point of that is even then it was the market had been pretty steady Eddie up until that point. Well, COVID hits, market goes all over the place. I have clients that were very comfortable that are now not comfortable, that really don't like seeing the gyrations. And really what it came to be is there was absolutely a lane for using insurance products that have capital preservation features in there, at least maybe smoothing out some of the ups and downs. But with that said, I built a financial planning practice that's really built more on the fee side versus the insurance side because with me coming up on the insurance side early in my career, I've dealt with enough of them to know that I need to have a certain level of healthy skepticism. The thing I best tell you is I grew up in the 80s. Ronald Reagan always said, trust but verify. That's how I feel with a lot of them, particularly with some of the ways that the products are sold. No offense to you salesman people out there. So that said, in the situations where we decided a capital preservation focused insurance product was the best fit for a particular client's needs, those clients in general have had some peace of mind during this recent downturn, and particularly during all the market volatility of the last couple of years. It does take some worry off the table. Does it mean that insurance products like this are for everyone? No, absolutely not. But it means that I am much more open-minded about it than I was 2 years ago. So yes, I both nailed it and was a little off. I'm correcting I'm learning, I'm evolving.
You're evolving. That's
That's
important.
right. What's happened when you get close to 48 years old? What happened? All right, what do you got next?
So fixed index annuity sales will level off as some of the features become less attractive in a down market. Nailed it or a little off?
I saw his wife. I was totally off. I mean, just not even close. So we talked about this earlier in the show, Michelle.
Oh, that's right. The percentage thing.
Overall annuities are up 27% year over year. Fixed index annuity sales are up 25%. So I don't know if maybe probably MIGAs are making up for that little bit higher one.
MIGAs?
Yeah, because you get a guaranteed interest rate. It takes some worry off the table, right?
Multi-year guaranteed.
Well, here's why. Here's why I think they're up. So let's talk about the positive side. My advisor brethren sometimes forget how important people's money are to them and how much they worry about it. Kind of like I did 3 or 4 years ago, I didn't take into account as much like, hey, more often than not, people just don't want to lose money. They like making money, but when things start getting sideways, really what they're looking for is, I don't want to lose money. So, my financial brethren be like, hey, don't worry about the 20% decrease in your account. It'll be okay. So when the markets are volatile and there's tons of people wanting to take some or all of that ups and downs out of their portfolio, annuities definitely provide some options to do this. Again, that's a broad statement. You got to look at the particular annuity, but there is definitely an outlet there for folks that don't want to deal with as much volatility as they would in like an index-based advisory account. The bad side of that increase, Michelle, is this crazy stock market, this up and down market. It's like chum to the insurance producer, shark salesmen. And I mean, I hesitate to say that. I say men because most of them are. And a lot of times they use fear tactics and inflated promises to snag a lot of investment dollars. These are the guys out there that are just making the rest of us look bad, that are trying to do the right thing. I need you all to stop it. You wear me out. You wear me out with the language, the 8.5%, da-da-da-da-da-da.
Reeling us in.
Just shoot people straight and read your own contract. And I'm not picking on anybody in particular, but you know who you are. So yeah, I was off on that. I thought they would level off or go down. Totally wrong. All right, what do you got? You got time for one more?
Yeah, I think so. And this is arguably the most exciting.
Is this radioactive?
Could be.
All right.
Could be. All right, so you said on more than one occasion that the Auburn Tigers football team would offer interim head coach Cadillac Williams a 2 to 3 year deal because there was little downside plus huge upside to making him the head coach. Well, they didn't do that. Despite my signing a petition. So do you feel like you nailed that, or were you a little off?
All right, so first, I was totally off, but I have a question. Is it okay to discuss this, Michelle? Are we getting into the religion or politics area?
It's going to have to happen. It's all. I mean, I've already been discussing it. Like I said, I signed a petition. I'm not super excited about the choice, but I think that Coach Hugh Freeze will probably mess up in a year and a half, and we'll have Coach Cadillac Williams as the head coach.
All right, so let me jump in. So I was totally off. Producer Mike may jump in too. We'll see. So here's the thing. I know Auburn is at least trying to do the right thing by making Cadillac the associate head coach.
And he got a considerable pay increase.
But I mean, Hugh Freeze, I mean, really?
Well, this is where Mike can jump in because
I mean, he called a bunch of what's the proper terminology?
Female escorts.
Female escorts. Okay, yes.
But
at least a dozen times. That's what they knew of.
Yeah, it seems to be the
And he lied to recruits that there's no major violations coming.
Yeah. Well,
I mean, I told you this.
Keep in mind. Okay,
all right.
This was several years ago.
I sound like an annuity writer here,
right?
So this was years before NIL. Okay, now with NIL, you can offer recruits pretty much anything. See Jimbo Fisher at Texas A&M.
Yeah, the payoffs are out in the open.
it's Mad Max out there.
Okay.
They were getting paid anyway. Now it's out in the open.
Also, this is a chance for Hugh Freeze to get redemption. And also, let's look at what he did at Liberty University. Having great winning season, turned them around, had some wonderful seasons with them. They beat Arkansas, which was a top 25 team at one point this year. The guy is seeking redemption.
All right.
Okay.
He likes to win. Auburn likes to win. We need to win.
And listen, to Auburn's credit, he has beaten. He's one of the few coaches that has beaten Saban 2 times in a row. And I know that was big for Auburn. Alabama is Auburn's national championship.
Okay.
Every year.
All right.
Okay.
Well, so I'm going to land this plane, Mike. Everybody gets a second chance. I get that.
Yeah.
And I like your words on redemption. I don't think I would get a chance at redemption if I was caught calling female escorts at least a dozen times from Michelle. I think that would be a deal breaker. But I hear what you're saying. So, all right, that is great stuff. Thank you for I appreciate your input, Mike. That's Mike Romano, our producer. Great stuff and great job, Michelle. All right, coming up next, we get to reach into our listener mailbag for our question of the week. Stay tuned.
All right.
Hi, everyone. This is Josh Knoll of Gulf Coast Financial Advisors. Are you looking at retirement in the upcoming year? Are you asking yourself if now is the right time to retire due to inflation and the stock market declines? Don't second guess your retirement strategy. Sit down with a professional or get a second opinion that you may need. Why don't you give Gulf Coast Financial Advisors a call today? You can find us at 251-333-5151, or you can visit our website at gulfcoastfa.com. That's GULFCOAST. FA is in financialadvisor.com.
Hi, I'm Michelle from Coasting in Retirement, a show that you might have heard on Sundays at noon. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
All right, so welcome back, listeners. Great show today, Michelle.
Thank you. Thank you.
It was a lot of fun. So we've got a little bit of time left, so why don't we check in the mailbag and see if there are any questions that need answered.
Okay, Josh. There's actually one from Paige in Fairhope.
All right. Hi, Paige.
And Paige asks, how much money do I need in retirement?
Oh, man, that's a big
also
question.
would like to know the answer to that question.
Okay, so this comes from Paige and Michelle.
In Fairhope, yes.
Fairhope. All right, very good. So first, that's a great question. Now, I don't want you all to get mad if I sound a little bit like a politician and tell you that answer depends.
It's a gray area.
It depends on what your lifestyle costs, right? You know, how much. A
lot.
That's fair. Well, and that's all relative. It's 100%. Any financial advisor has been doing in the business, especially as long as I have, or has been doing this for a while, will tell you that it's all relative when they come in, what their monthly lifestyle costs, what they like to spend things on, whether it's eating out or travel or, multiple houses, whatever, or shoes in your case, yes. So it all depends. But as we stated previously in this episode, also, people have to remember they tend to not dramatically reduce their lifestyle in retirement. So we have to take that into account when someone says, how much money do I need to retire? All right, so there, the foundation is laid. Now let's answer the question. So in the old days, you had what was called the 4% drawdown rate. And what that meant is if you had a bucket of assets, you wanted to draw down 4, say maybe 5% from that bucket every year to fund your lifestyle, that would hopefully give you enough to still have some capital gains appreciation where you're not having what we referred to earlier as a drawdown risk. So, for example, simple math, if you had $1 million in investable assets at 4%, that would be $40,000 per year. Okay. So first question to you is, Michelle, how many couples do you know that could live on $40,000 per year?
I don't know of
Not
any.
Very many. It would be very tough. It'd be very tight. So what has happened over time is that 4%, even 5%, $50,000, and this kind of puts a nice little bow on our inflation conversation. Even if you take out the rapid inflation we've had over the last handful of months, even with that, the world just is hard to live a lifestyle that you want to with that type of drawdown. So what we really have to focus on in retirement when someone says, how much money do I need? It's not so much the bucket of money that they have, it's how much income can we produce from that bucket of money. All right. And so with that, it's a combination of strategies. You're going to be looking at part of your portfolio is going to be specifically designed to fight inflation. Part of it's going to be designed to produce income. Part of it's going to be designed for capital appreciation. And really what you're trying to do is you're trying to put together a mix through a comprehensive financial plan that gives somebody the amount of money they need to live a comfortable lifestyle. Because if they've lived a $100,000 a year lifestyle while they're working, they're going to live at or near that amount when they get into retirement. You have to account for that in a comprehensive financial plan. And that involves using planning software that helps you project out and just see, hey, how can we manage this? How can we find a good fine-tuned middle ground there where you are living the lifestyle you want to, you're preserving the capital that you want to, you're getting the income that you want, and hopefully, if needed, you've got something that fights inflation. So that is how we determine how much money do I need in retirement. We kind of back into it. There's no magic number, but it all starts with a conversation. So on that conversation note, if you folks want to reach out to us, you can reach us at 251-333-5151, or you can always find us at gulfcoastfa.com. That's GULFCOAST, FA as in financialadvisor.com. You can reach us through there, set an appointment, or you can always call us at that number. If you don't reach us, leave a voicemail. We will call you right back.
So I'm an independent contractor with about 5 years left before I would like to retire. I've got a 401k from a previous employer and could contribute as much as I could to my traditional and Roth IRAs, but I'm concerned that it won't be enough. What options do I have to really go hard at my retirement savings as I prepare for retirement?
All right. So first, great question, Nathan. You're in what we call the retirement red zone, which we are football fans here. It's a football-based reference. I got to give credit to my good friend Jay Stubbs. And really what it means is you're approaching the goal line and you're hoping to score in retirement. It sounds like what you've been doing is fine, but now that you're seeing the end of your accumulation years coming soon, Nathan, you're probably concerned about the size of the bucket of money you're holding in your qualified investment accounts. So there's a couple of ways for self-employed or independent contractors or small business owners to run, again, a football reference here, a power play and get the proverbial touchdown football into the end zone. So these options definitely require conversations with a financial professional. So let's just touch on them in broad terms. There are solo 401k options that provide considerable more contribution limits than a traditional IRA or Roth IRA. And same with SEP IRAs. The limits are not exactly the same, but they're very close, and they're definitely significantly more than those other two options. There's also cash balance plans that sometimes make sense for small business owners that can provide significantly more tax-free contribution limits. You will need the help of a qualified actuary to implement that plan, but that plan or any of these other options we've listed, we can help. All you got to do is give us a call at 251-333-5151, or you can make an appointment on our website at gulfcoastfa.com. That's GULFCOAST, FA is in financialadvisor.com. So, folks, that's it for us this week at Coast and Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton. Thank you.
You're welcome.
Yep. Thank you to our awesome radio station, 106.5 FM. Many thanks to the provider of our show music, local band Sloth Racer. And as always, a sincere appreciation for all of you out there that have been listening and joining us on this journey. Of course, we'd love to be a part of your journey as well. Until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.
Imagine for a moment that an intense storm is pounding your house. Will your roof leak? Will the siding peel away? Will your basement flood? If your house is properly built and maintained, you'll be fine. What about your 401k or investments? The stock market's had a great run the last few years, but is its current turmoil making you feel uneasy? Are you confident your portfolio is built to weather a financial storm? Well, now might be a great time to get a second opinion on your retirement plan. Call Josh Knoll and the team at Gulf Coast Financial Advisors, 251-333-5151. They'll examine your portfolio and show you if your investments are in need of some weatherproofing. Get your no-obligation second opinion by calling Josh Knoll and the team at Gulf Coast Financial Advisors, 251-333-5151. Don't let your retirement get caught in the rain. 251-333-5151.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.